Well, last week was a doozy. My name is Hamilton. I'm here at the Trading Initiative. Let's talk about whether or not we should be worried heading into the new week. The NASDAQ closed down 5 days in a row, one of the few times that has happened over the last few years. Is that cause for concern? Is that going to turn into a bigger move? Let's talk about it. But before we do, I'd like to go ahead and point out that if you like this type of content, the market research stuff, check out the link in the description below. I send out stuff like this every single day. Trade ideas, market updates. I highlight important themes, sectors, industry groups, etc. All of this stuff sent out to you via email or your cellular device. We do have an app that you can download on your smartphone, and you get awesome emails like this, what a warning sign would actually look like. So let's actually talk about this really quick. It's a nice little segue. We're talking about the market in general. What would a warning sign look like, right? We just went through this very, very choppy week in the markets 4 days ago, posting this. What would a warning sign actually look like? And there are some charts that I look at on a day-to-day basis, right? Particularly charts that give me a bird's eye view on risk on, risk off mentality. That's really what I want to look at. So I went and highlighted a few of these inside of this newsletter, and I'm going to go ahead and talk about them right now. The first one being high beta versus lower volatility stocks. If we look at over the last few weeks or months, this relationship has meandered sideways, but still has yet to roll over. It's not the most bullish looking relationship. In a strong bull market, we would expect higher beta stocks to really outperform lower volatility stocks, and they just haven't. But you aren't seeing a complete breakdown of higher beta stocks against lower volatility. That means leading industry groups such as software, such as internet, for a while, semiconductors, stuff like that, starting to underperform consumer staples and healthcare and utilities. We're just not seeing that. So that would put me in the bullish camp. Risk is still on in the market. Number two would be the consumer discretionary versus the consumer staples relationship. The consumer discretionary types of stocks, your Teslas, your Amazons, your Home Depots, your Lowe's, generally where you go, if you have a lot of money and you want to spend it, what types of companies you're going to, versus consumer staples, right? Your Walmarts, your Krogers, your Coca-Colas, etc. Things that tend to do well even in a bear market. Well, in a strong bull market, we would expect consumer discretionary to be outperforming, right? Makes total sense. That's where a lot of the higher beta stocks are. That's where the opportunity is in a bull market. And therefore, we would expect the ratio to be moving up and to the right, and it is. So once again, another bullish sign in the market. Even with the pullback, consumer discretionary is still outperforming staples. Thirdly, the dollar, right? The one chart that actually does throw a monkey wrench into our end of year bullish setup idea is that the dollar inverted is breaking down. So we know that there is an inverse correlation between the dollar and stocks. Whenever the dollar starts to rally over the last 2.5 years, the stock market has suffered greatly, right? And whenever the dollar starts to break down, the stock market tends to do very well. It's a decision based off of whether or not people would rather own cash, dollars, or stocks. Makes total sense. Well, since the Federal Reserve started to cut interest rates, the dollar has been on a warpath higher. I inverted the chart to show you the relationship. As this now breaks down inverted, the S&P 500 may have some headwinds as the dollar continues to show strength and potentially wants to break out into a 2+ year high. The stock market is going to continue to feel the weight of that and potentially start to pull back. This is the one chart, I think, out of everything that is throwing a monkey wrench in that end of year bullish setup that we have. The fourth chart is talking about market breadth, right? Looking at the equal weighted S&P 500 against the non-equal weighted S&P 500. Is market breadth holding up? Well, so far it is. Last one I want to look at is credit spreads, your high yield bonds versus your treasuries, right? Everyone's freaking out about a potential credit event. Banks are about to roll over, etc. But I don't see it. The market is not pricing that in whatsoever. As a matter of fact, the smartest and most liquid market participants are still preferring to buy high yield corporate debt over relatively riskless treasuries. So that to me screams risk on. There's really not anything here other than the dollar screaming at me that I need to watch out. And if we go back and actually look at this on a actual price action basis, we're not necessarily breaking any key levels here. Now, I'm not saying it wasn't it was an easy week to be trading. Absolutely not. Particularly if you opened a bunch of exposure post-election breakout. We didn't inside of TTI. We had been buying stuff since the August 5th breakdown. So 2 months ago, we were buying literally everything that we could that was showing strength. And over the last 2 weeks, we have not really opened up a whole lot. We've been managing some big trades that we're in. This is not the type of market environment that we want to run and buy a bunch of new positions. We laid the groundwork months ago when we saw strength in the market. Now it's all about managing those open positions. And as the market pulls back, we're going to continue to add exposure in now. Now is the time to start thinking about, okay, where do I want to start adding new exposure? Not when the market is gapping up and running, because you're paying an incredible amount of money for the same opportunity somebody bought prior to the election. That's just not the type of trade that we like to take inside of TTI. So some key levels here that we're looking at in the S&P 500 that makes sense to me is somewhere underneath the 570 area. For me personally, is probably be a little bit less risky in the market, right? Take out a little bit more of exposure. But until we do that, I fully expect that we might fill this gap to the downside, the 577. And I do think that's going to hurt, particularly the chasers, a lot, but it's not necessarily going to change my idea of an end of the year bullish setup, right? Primary trends still remain up. Intermediate and long-term trends still remain up. The short-term trend is absolutely down in the S&P 500. And I wouldn't be surprised to see short-term weakness come in and look to fill that gap before bouncing. But this gap here, if it does bounce, is going to be crucial. I want to see when or if it bounces. And if it does, I'll be adding more exposure on the right side of that bounce. I'm not trying to front run this, because if it doesn't bounce, I'm not going to be adding into new positions as they're losers. The Qs underperforming everything last week, right? Particularly Mag 7 stocks got hit. As long as we're holding somewhere above 490, 495, I'm not necessarily worried, right? If we start breaking into some new lows on a week over week or a month over month basis, yeah, we can start having the conversation of should we be looking to limit risk into the end of the year, but we're not there yet. I'm looking at this as an opportunity for a tactical dip. We want to be buying, but once again, we want to wait for the actual bounce. Now, this is all in the backdrop of arguably the most important earnings all year, which is NVIDIA on Wednesday. We're going to be live streaming it, by the way. We're going live at 3:50 p.m. Eastern Standard Time. We'll be live till about 5. We're going to be talking about potentially trading after hours. So if you're interested in that, show up Wednesday, 3:50 p.m. Eastern Standard Time. But NVIDIA is reporting on Wednesday, and this is going to absolutely move the market in the short and potentially the intermediate term. This is the face of the quote-unquote AI bubble. This is the entire face of this bull market right now. This is the stock that really all of the Mag 7 stocks have been trading and trending towards. NVIDIA hitting higher highs over the last few weeks, but now consolidating sideways over the last about 10 trading sessions into the earnings report. Which way this goes, I have no idea. We have exposure in NVIDIA. They're completely free trade. So if NVIDIA tanks, we lose nothing. If NVIDIA gaps up, we make a bunch of money. Those are the types of trades we like to take inside of TTI. And once again, we were opening trades after the August 5th breakdown, once we saw that the market didn't really want to continue to break down. We saw that strength early. We started buying those early leaders, and that has worked very well for us. So we're sitting in a bunch of positions in NVIDIA right now, riding through earnings with no risk against us. But once again, it's going to be very important. Not necessarily what NVIDIA has to say. That's not my game. I don't interpret earnings plays, the actual reports themselves, but I do interpret the way the market reacts to those. And if the market sells it off, I think that there's an opportunity for the indexes to potentially threaten new weekly and potentially monthly lows. And that's going to throw a wrench into that end of year kind of bullish setup that we've been talking about. So once again, NVIDIA is incredibly important on Wednesday. The Qs in the S&P 500 have been drawn down. They're sitting at these kind of gap fill levels, and the Russell 2000 as well. Russell 2000 is less correlated with the S&P 500 and the Qs, and particularly NVIDIA, right? There's no exposure in there. But still, the overall post-ramp election is being sold off. And in this case, the Russell 2000 is looking to potentially fill this gap down towards 225. And if that happens, what's the broader implication of the small cap space, which was just at 3-year highs and potentially pressing into all-time highs? This is the seasonally favorable time of the year to be along the small cap space. So if we don't bounce at the 225 area, is that indicative of a theme change? Is that indicative of a change of risk sentiment in the market? I think it's time to have that conversation if we don't bounce. Now, I don't front run anything. I'm not sitting here telling you that it's going to or it's not going to. I'm going to simply wait and see how the market reacts. At these key levels, I think NVIDIA is going to be the catalyst and really give us the directional move through the end of the year. So we're going to sit tight and wait until obviously post Wednesday. Thursday is going to tell us a lot. If we look at some of the stuff that we look at all the time in terms of this risk idea, right? We were just talking about higher beta versus lower volatility, but I want to kind of take it into a different direction. We use this idea of risk on versus risk off. And all I did was I took a basket of risk on assets, added them together, and then divided them against a basket of risk off assets. And I care more about trend than anything else. Are we trending upwards? Are we trending downwards? Are we trending sideways? As of right now, we're still technically trending higher above an upward sloping 200-day moving average. So you have to give a favor or an edge to the bull side of this equation. If we're looking at risk on assets versus risk off, we're still firmly in the risk on category, which continues to tell me that even though the markets are pulling back, particularly on an index level, we don't necessarily want to get out of all of our longs. We don't want to be shorting everything because this particular ratio has kept us moving in the right direction for the last 2 years. As long as this is hitting higher highs and moving upwards and to the right, we don't necessarily want to get out of everything and start shorting it because it's not time yet. Now, the Mag 7 index did take a hit last week. This was just up at all-time highs, pressing up in towards that 1.618 fib extension. I think that makes sense to find resistance here, but what matters to me once again is NVIDIA is the last Mag 7 stock to report. So we've had 6 other, obviously very, very large and important companies already report. NVIDIA is going to be the last one here. Does NVIDIA cause this to re-break out into all-time highs, or does this kind of fizzle out here and start taking a nosedive down towards the 200-day moving average? I don't know, right? Overall, trends are still up even with the pullback. We were just at all-time highs 2 or 3 sessions ago. And so while it does feel bad trading in towards this week, if you're holding these Mag 7 indexes and you opened them over the last week or two, it doesn't actually look like from at least a grouping standpoint that this trend is over. This looks like a very reasonable pullback at a key level with that 1.618 fib extension. That sucks sometimes to hear, but it does make sense to me that they would find some resistance up here and then pull back. Whether or not that follows through, we'll know probably Wednesday afternoon or Thursday morning. Now, some leading areas of the market. I want to pull over on Koyfin really quick. If you're not aware of what Koyfin is my favorite tool to kind of dive into the bigger picture. So inside of TTI, we like to build the bigger picture. We're a top-down swing trading group, right? Technical research all based around the bigger picture first, and then we plug the stocks in that make the best sense. And there's no better tool than Koyfin. I'm not getting paid to tell you that, but I am a 100% believer in this tool. And if you like the type of stuff that we do in here, Koyfin is invaluable for your process. If we look at a year-to-date performance of all of the different sectors here, financials are still outperforming. Right. So once again, everyone's worried about a banking crisis. Everyone's working about a credit crisis. Banks have like silently outperformed over the last 2 years. Nobody wants to own these banks, and that's totally okay with me because there's a lot of banks that we own that are sitting at all-time highs, and I don't necessarily have to worry about these breaking down 20% because they're not overly crowded trades. Right. If you get into the trades that nobody wants to get into, the odds of these whipsaws occurring decrease drastically. Like think the Morgan Stanley trade that we're in right now that we have till June of 2025, and those are up 400% right now. Nobody wants to own Morgan Stanley because it's a boring bank. We'll own it. That's totally fine. But financials are performing very well. And as we'll see in a second here on a quarter-to-date basis, regional banks are performing very well. Your regional bank industry group is a high beta industry group out inside this financial sector. Communications just sitting at all-time highs, and which begs the question, how risky is the market right now if communications is up there leading and also up into all-time highs? These are your Googles, these are your Metas, your Netflixes, your telecoms that some of them are doing fantastic, some of them suck, but apparently enough of them are doing well enough to skew that communications up into all-time highs. But look at the areas of the market that are up at least 20% this year, and then look at the areas of the market that are not. Now, we're going to give a little bit of a caveat to tech. Tech has underperformed going back to the July highs, but it's really semiconductors that have underperformed because internet and software, which we'll see in a second, have performed very well. But energy, consumer staples, real estate, materials, and healthcare have just really underperformed on the year. And so it's not really in our best interest to go and open up a bunch of new exposure in those types of areas. And if we actually bring it into the quarter-to-date chart, you'll see that they have drastically underperformed since the beginning of October. It's just not worth our time to open this stuff up. Utility staples, real estate, materials, healthcare. So we're not going to go dumpster diving for this stuff. It just doesn't make sense because even though last week was kind of difficult to open up new longs, the market is not, at least to us, signaling risk off yet. And so we're not going to want to go and open up kind of that lower volatility defensive type of posturing. We're going to want to continue to look at opportunities, particularly if the indexes bounce and the higher beta areas that are outperforming the market. So we're going to go ahead and look at this from an industry group standpoint as well. If we bring this year to date, once again, semiconductors have not really done a lot since those July highs. They've underperformed the market. Meanwhile, names like software have done very well recently. Names like internet have done very well recently. A lot of these things, if you're inside of TTI, you know this, but in your scans, you should be seeing a lot of these stage 1 into stage 2 breakouts, particularly those higher beta software stocks. They're everywhere right now. Twilio is one that we're in right now. Affirm is one that we're looking at or are in right now. Square is setting up right now. Zillow Zoom. A lot of these stage one software stocks are breaking out into stage two uptrends, and they're everywhere right now. That's definitely a setup and a theme that you should be looking at if you're not already looking at that. Going to the quarter to date chart, I was just talking about regional banks, right? But who had Jets outperforming everything else quarter to date? Not me. You took me back to the late August, early September window where we started to notice that Jets were outperforming. I did not expect Jets, which, by the way, some of these are sitting at all-time highs. United, I believe, is sitting at all-time highs. Delta might be close as well. Did not have that on the bingo sheet. But regional banks, we had a reasonable expectation would do well, and they are. They are doing very well. Regional banks, think about this was supposed to be the doomsday bringer of the markets last year, the regional banking crisis. It took, 17, 18 months, but here they are right back up to those key levels and starting to re-break back out. Software we're just talking about outperforming right now. A lot of those stage one into stage twos, internet as well, and energy actually starting to pop up slightly as well. What is not working well? Solar, gold miners, biotech had the worst week it's had in years, I believe. Clean energy, some of the lower volatility REITs and stuff like that, just not worth our time even looking at that stuff. If we look at this from a sector group going back 1 day, 1 week, 1 month, and 3 months, this is FinViz, by the way, you can see where the risk and opportunity has been pushed into the market, right? So you're going to want to own risk on areas when the market's performing well. And as you can see, going back the last couple of months, consumer cyclical, communications, financials, this is the type of stuff that has really performed well. 1 week, financials have held up very well. This is information that you need to be looking at. What is holding up well when the market is pulling back? Financials have held up very, very, very well. And that's the type of information that you need to take, because if you're looking at stocks to own, go and find those stocks that are leading within that particular sector group, right? Does that make sense? If we flip on over to TradingView really quick, I'm going to talk about some of these. Let's talk about those stage one into stage twos, right? We're talking about the software stocks, internet stocks. They're setting up. They're everywhere in the scans right now. We have a bunch of these trade ideas out on TTI right now, and a bunch of them are working. Let's look at one that's setting up right now, though. Square here is setting up into a potential stage two, and this one has been on everybody's radar because it's a well-known name, but it's faked people out time and time again trying to get up and over this 85 area. Is this the time for Square to actually break out? There's a good opportunity for it, absolutely. FinTech in particular is running. This industry group, this market cap is running well right now. We're trading north of an upward sloping 200-day moving average. We're within a bullish momentum regime. This is a good opportunity to potentially try to grab Square above $85 and run the fibs for price targets. Anywhere between 110 and 115, and anywhere between 155 and 160 makes total sense to me as long as you're managing your risk. And this is a great opportunity to buy some straight calls as well. IV is rather low. We go out into 2025, we're buying straight calls. We like these open big blue sky type of setups where if we actually go ahead and click on the VRVP, you can see that there's no real overhead supply that we have to worry about. A majority of the supply here is actually financial institutions accumulating it in this horizontal channel over the last 2 years, right? You can see it with this mountain of volume here. The financial institutions have been buying shares for the last 2+ years in Square, and it's time to finally let it go. And so as it breaks above 85, we expect relatively low amounts of resistance in these stage two breakouts to really start to form and push. So Square is setting up, but a stock that we're already in right now that is doing exactly what we expect Square to do is Twilio. So we bought this particular stock at the 69.5-ish area prior to earnings. A couple of the guys inside front ran this. A couple other people grabbed it after the PEG, power earnings gap. But this has hit our first price target and is up rather large for most people inside of the group that grabbed it. I currently do not have a position, but that's okay. Another stock that is doing well is Zoom, right? Same type of idea, these stage one into stage twos, working itself way up there towards that 88 area. This is a free trade for us, but this is the type of stuff that's now running in the market. We're finding it everywhere when we scan for this stuff. The software stocks that have been beat to crap that are coming back, they've set these big long bases and now they're starting to break out. I've looked very, very, very good lately. So once again, if we're thinking about this from a broader market standpoint, is the market starting to pull back? Well, last week definitely was a pullback week, but if you think about from a risk standpoint, an ETF like IPO, Renaissance IPO ETF, this particular ETF looks at some of the most risky assets in the market, things that just got listed, and it's still pressing up in towards new highs, new yearly highs. Is this really indicative of a bearish market? To me, no. I would expect this to be rolling back down below the 200-day moving average, and then risk would start to really come out of the market, right? If you think about it, risk managers are going to sell off the riskier parts of the market first before they get rid of some of the blue chip stuff. That makes total sense. These are the types of stocks in the IPO ETF that are going to lose a hell of a lot more than something like an Apple would in a bear market. And as of right now, they're still buying this stuff. And if we really want to talk about risk, let's go there. Let's talk Bitcoin. Let's talk crypto market cap in general. We were noticing this on Friday. The market did not look great on a weekly basis into Friday's close. And yet, for whatever reason, Bitcoin was just hanging out here consolidating near the $90,000 area. Now, what we had talked about at the end of Friday inside of the Discord was if the market really was going towards this risk-off kind of mentality, if liquidity was being pulled back out, well, crypto should be negatively impacted. In TTI, we look at crypto as just an exit valve for market liquidity. And in a risk-on environment, that liquidity permeates in towards the most risky areas of the market, and those tend to react positively. In this case, crypto, right? Crypto is an extension of the TradFi market at this point, and it's highly correlated, particularly with higher beta stocks. So higher beta stocks got killed on Friday in particular. We were expecting Bitcoin to get killed if the market was truly shifting towards risk off, and we're just not seeing it. As a matter of fact, it looks fantastic. Bitcoin is holding its rally, and if we actually look at this from a total crypto market cap, we're pressing up in towards all-time highs above $3 trillion. Once again, if the market was freaking out and this was a risk-off type of environment, we should be seeing it in stuff like in assets like crypto. We should be seeing it in the total crypto market cap, and we're seeing the exact opposite. We're seeing risk slowly come into the market during the weekend. So, using this idea of weight of the evidence that we utilize inside of TTI all the time, we're just not seeing it yet. We're not seeing risk come out of the market, and therefore we do think the indexes are going to bounce, right? We do think that this is going to be a short-lived pullback. I think the market is freaking out about a bunch of things. I also think that the market tends to try to screw as many people as possible. And post-Trump admin election, the market rallied on euphoria, and everybody was talking about how this is it, we got to get in, the Trump rally's back, and it's just like that. The market comes in and just sweeps everybody out from underneath their feet that were chasing it. To me, this is totally normal in this type of environment. I'm not saying it's easy, but I'm saying it makes sense to me. And I'm not yet ready to throw the towel in, particularly when some of the more risky areas of the market are responding relatively well. And I think that's a key word, relatively well. Not necessarily saying Bitcoin's at 100 grand yet, but it's not down. And the total crypto market cap is actually up over the weekend. So to me, stuff like this is making me lean towards look for those stronger stocks that are showing relative strength as the market pulls back, those financial stocks, the communication stocks, particularly the consumer cyclical stocks, some of the tech stocks, software, internet, stuff like that, and expect that when the indexes bounce, those are going to lead through the end of the year, right? That's kind of where my head's at. Obviously, all of this stuff is up in the air right now because NVIDIA's earnings matter a lot. So on Wednesday, at least Wednesday afternoon, I think we're going to have a better understanding of which direction this market wants to go, and we'll play it appropriately, right? One more time, if you're interested in this type of stuff, I send out emails at least once a day, filled with the most important market trends, sector, and industry group updates. And you can take all of the trades with us as well. We put out these awesome reports on a daily basis that show you the best types of stocks that you could potentially get in certain parts of the market. And then obviously we bring them over to the trade ideas tab here, and you can see some of the trade write-ups that we put out. Crypto is now included as well. So shout out to our guy, Josh there. One of the most recent trades that we put out is MGNI. You can see a very nice stage 1 into a stage 2 breakout with all the pertinent information. But if you like this type of stuff, click on the description, click on the link in the description below, and you can get all of this. All right. I appreciate you hanging out with me on Sunday. We'll see where the market's at. Once again, we are running the NVIDIA earnings on Wednesday. So if you're there, feel free to hop in and talk some crap. We'll trade it together. If you're not, that's fine too. Catch you in the next video.